Well, welcome everyone. As we always do here, we're going to wait about 3 minutes to 10:03 Pacific just to make sure that we got everybody joined here. So we'll be back in 3 minutes. Well, all right, we're going to go ahead and get started now. Again, welcome everyone to our webinar on our integrations that we have with Fannie Mae. I wanted to just take a step back and kind of set the table with regards to what we're doing with these webinars. This will be a first of a series, just kind of going over some of the existing innovations that we have on the execution side and some of the new innovations that we're working on. Look, we're obviously not going to address the kind of the current market environment. That's obvious. If you look at what MCT's responsibility is to you, the lender, first and foremost, it's obviously protecting your pipeline profitability in a market like this. But a very close second, as you all know, for the MCT clients on the line, is to help you squeeze every basis point you can out of the production that you're doing. And obviously, in an environment like this, where we have the volume issues that we do, it's more important than ever to squeeze as much execution as we can on the backside, on the capital market side of the production that we're doing. And there's no better place to start than with Fannie, because and for those of you that have been on webinars with me before, and frankly any of us at MCT on the execution side, we always mention this, that the industry as a whole, and it's not just because Fannie's on the call, the industry as a whole owes a lot to Fannie with regards to the technology and the resulting transparency, efficiency, and granularity of pricing that they brought to the market. And so there's, some future innovations that they probably, can't talk about publicly, but definitely are working on. But there's a lot of there's a lot of innovations that they've, over the last 6 years that they have pushed to the market that have really helped us, frankly, extrapolate to the rest of the market and also take advantage of for your execution. So to jump into the presenters, we have Mike Toner, and Mike has been MCT's guy now for I think about 12 years at MCT at Fannie Mae. He's in the market transactions advisor, but been a lot of you guys know him on the Fannie trade desk. My name is Phil Rasori. I'm the COO of MCT. And then we have Paul Yarbrough, who is the head of our client success group. And he deploys all the technology to our client base when we come out with these integrations. And so, again, just going to the agenda here, we're going to talk about some of the existing integrations. Paul will tell you, and I think, again, going back to what I had said earlier about Fannie and what they've done for the market here, I want to kind of get Mike's comments on just really where where the vision is, why they brought some of these features to market, because I think that will help us all kind of understand on where their head's at as far as continuing to bring further innovations to the market, which we're all excited about. Then on the benefits of the API integrations, we're going to bring Paul Yarbrough in. He can speak to some of the operational benefits. When I say operational, that's operational on the capital market side, so on the committing and execution side. And then Paul will do a little bit of a demo. And then, as I said at the beginning, this is the first of a series of webinars. So we'll talk about just quickly some of the future innovations at MCT. And again, some of those will involve Fannie, but not for public consumption now. But we will definitely talk about some of the future API innovations that we've got coming along here. So if we move into the API integrations, just of what we've currently got specific with Fannie, there's the Fannie Mae Connect whole loan purchase advice API. That was the latest. I think I'll start from the bottom here. The pricing and execution whole loan API. Those were the APIs that really changed the industry. And when we just taking a step back, if you look at not to get too technical, but the specified pay-ups that exist in the back end in the capital markets and the securitization markets, that for those of you familiar with capital markets have all heard of, things like low loan balance pay-ups, and the most popular to talk about is the sub $85,000 security, where there's dramatic pay-ups that exist in the securities market. And when we say pay-ups, these are basically premiums to the TBA price that will be paid by an end investor. And when we say investor, this isn't the loan buyer, this is the security buyer. And what really was sad about that prior to these APIs was that the whole reason that those pay-ups existed was that the borrower of let's say an $84,000 loan is mathematically stuck in the loan. And again, I know this is review for a lot of people, and probably insulting some of your intelligence here on the line. But for those of you that don't haven't heard much about specified pay-ups, there's obviously costs that go into refinancing your loan as a borrower, appraisal, title. Those costs basically eat up any gain that you're going to make on your rate reduction when you do a rate term refi, a heck of a lot faster. They eat those up a lot faster on a small loan than they do on a large loan. So therefore, the life expectancy of that loan is far greater than a normal, let's say $500,000, conventional conforming loan. And so that small loan, that borrower is stuck in this above market interest rate. So historically, there was just zero way for the lender to pass that pay up to the front end, right? Which is, if you think about it, a little bit egregious, because the industry is getting paid up on this, on this security, because this, frankly, low income borrower for this smaller loan is getting stuck in this loan. That's what was happening. So back about 6 years ago, I believe, maybe it was closer to 8 years ago. Mike might be able to give us the exact dates. Fannie began passing through these pay-ups that they receive on the whole loan conduit in the form of separate programs. And Mike, this is where I'd love to bring you in and kind of, maybe you could go over kind of your guys' vision there, because we strongly believe over here that really changed the market, allowing lenders to price differentiate on the front end for these specified pay up executions, and then we'll talk about down the road about leveling the playing field. So you had the smaller lender now able to get these pay ups when they sold their loans, versus the large lender that could securitize and scale their securities. And that, of course, creates a more better competitive market as well. But Mike, maybe you can talk about just kind of your guys' vision there.
Yeah, sure. Thanks, Phil. So yeah, I think, the key here at Fannie is, we, of all the investors you have to choose from, we're the innovator, right? We're usually first to market with stuff. And I think the spec story really was a perfect example of how we do that. I think there's no secret what Fannie Mae does as far as how the cash window operates, right? Obviously, we're buying loans for many of the lenders that are on this call. And we take those loans and we sort through them, and we no longer really run a portfolio. We really securitize everything that we take in. So with that being said, we know where those stories kind of trade in the marketplace. We were forming those pools and putting it out there and getting the payups. And what we did in the past is, the way we did is we would bake it into your price. So when you log in the cash window, you see a price, and that's what you got. And you couldn't see it separated. And I think we got a lot of feedback from our partners that just said, look, it'd be great if I could see it, see what the values are. And so we made the decision to just kind of to do that, right? So, and Phil, I think it was probably, I can't believe this, it probably was about 8 years ago, we decided to separate the buckets and break it down. For example, the one that's most notable is the 30-year less than 85. When you look at that, especially when rates are dropping, those payups can be pretty large. And so we decided to put it out there. That way, lenders could come in, they could take down their commitments, they could see the price difference, make sure it was worth it, hit that bid, get a nice bump to the P&L. And then they also have the decision, too. You think about it in a market where margins are getting extremely tight like they are today. You as a lender have the option to pass that on to the borrower to get more competitive. So we thought it was the right thing to do. It turned out to be pretty successful. I think our lender partners, I think they like the transparency, right? Us putting our best foot forward. And it's kind of a continuous thing. So I think when we went out, we started with the obvious ones, right? It was the low balance story, so less than 85, less than 110. And if you looked at it, you've seen it, the stories kind of progress over time. I think the way we see it is that we're seeing a story develop in the marketplace. And if we think it's liquid and it makes sense, and if we're actually forming those pools, we think it's only fair that if we're getting those payoffs, that we pass it back on to our lender partners, which is fair game. I think the kicker comes in is at what point do you get to a situation where you have too many stories, right? It becomes very hard to manage. Are you really getting a lot of pay up? Is it only like a bip? Is it worth it? So we look at all those things, but as the stories do develop, and they're always going to change, if we can put it out there and pass that value on to our lender partners, we're going to do it. Are we going to be able to create every story that's happening out there? Probably not. I mean, if you get to the point where you have 50 products out there, does you get to the, I guess, the point of law of diminishing returns? It just depends. But that being said, I think with the technology that we develop with MCT, with the APIs, it gets easier to manage. So I think that's kind of the vision. You know, we want to keep this going. We think it's been a great win for Fannie. We think it's been a great win for our lender partners. We think it's been a win for MCT. And at the end of the day, look, it all comes down to really the best X, especially when things are tight. So we can give you that pay up. It's awesome. And as we incorporate these technologies and things get more efficient, we hope that that efficiency gets kind of transformed into your best X, and it's a win-win for everybody. So.
Yeah, no, absolutely. And no, I appreciate that, Mike. That's a great background. You know, I think just as far as speaking to the, you know, what we see on the lender side, you know, and the benefits of the cash window, frankly, we definitely won't have Mike speak to this because it's, you know, touchy, but look, you know, January 14th of 2021, when these little PSPA announcements came out, you know, we were, as far as caps of what could be delivered to, you know, to the cash window and pushing more people to MBS. You know, the biggest issue that we frankly had was specific to what Mike was just talking about those spec pay-ups, that it removes transparency from the market. If you know, if you only have the very large groups able to achieve the securitization execution on these specified pools that require minimum amounts of loans to be securitized, you just don't have an efficient market. And so this is what really you know, created the efficient market in those specified pay-ups. So, you know, next, I think the next thing, and gosh, this one probably is, I guess, 3 years ago, was the, you know, SMP, the servicing marketplace. So that was basically taking, you know, what we felt, you know, we felt was kind of the same thing, a little different, but in the same in the same vision of transparency, transparency and efficiency in execution, being able to have basically small to mid-sized lenders be able to execute on the cash window, but then also sell their servicing on a flow basis, and sell their servicing on a competitive flow basis. So there's servicing buyers that you know will be able to we'll buy on the flow, but we can ping the pricing and the servicing execution in that API. So it all comes back at the same time. And so from our, you know, our bread and butter, you know, mid-sized lender customer who's selling to the lender, selling to aggregators on bid tape executions, looking at AOT executions, looking at cash window executions and retained servicing. Then there's also cash window, selling your servicing co-issue. This was very, very interesting because it enabled lenders to be able to get the same cash benefit of selling their servicing at the cash window, but the cash was actually taken out at the time of purchase of the loan asset. So big innovation there. And again, the transparency for our best execution, you know, was great there. I think, Mike, I think, you know, I know that on this, you know, the servicing execution side, you're more focused on the desk and how the securitization markets affect the asset pricing that you guys are delivering through the cash window. So I know the S&P is not as much your specialty per se, but do you have any kind of comments on kind of what your guys' vision was there?
Yeah, I mean, once again, I think it was, the concept, we keep saying the word innovation, and that's what it was. But I mean, you can imagine, I mean, we get a lot of really good feedback from our lender partners. We get a lot of great feedback from MCT. And, over the course of time, I mean, there was a period of time where we didn't really talk about MSRs back in the day. And all of a sudden, they became the biggest thing. And I think some of the feedback that we're getting from our lender partners is that it was just it was complex. You would talk to different servicers. Everything was different. The minimum requirements, how you got set up, the platforms. And so, based on everything we were getting back, and this is really geared towards some of the smaller sized lenders that didn't have the ability of the larger guys that we talk about, and we're going through the cash window, was, well, let's bring them together. And that was really the concept of it, right? We got servicing buyers out there. We got servicing sellers. Let's just bring a platform where they get together. When it gets in the price and all that's not up to us, like you said, Phil. We're worried about the asset price. We don't get involved in that, but we just want to create a one-stop shop where everybody can come together and get things done. So once again, back to efficiency, best X, making it simple. And it started off as set. It was loan by loan, and then we roll with the S&P, which is now obviously bulk. So once again, I think it's innovation. As the market adjusts and changes, we'll make changes to the tool that are going to help out our lender partners and help out our buyers.
And just for those of you on the line here that are not familiar with the old co-issue process there, and what still exists today, there on the buyer side, historically there was these contracts that were there would be a certain amount of production that needed to be delivered over a period of time. And if you think about that, if you take a step back and you think about, look at this market, right? Just changing interest rate markets, changing environments, changing, frankly, house pricing indices. It doesn't make sense from an efficiency standpoint that you would have a fixed servicing grid, albeit based on a rate shock. It doesn't make sense that you would have a fixed grid over a 90-day period, and that historically, or up to a 180-day period, that historically was, what happened, and so we really strongly believe at both the agencies, frankly, that this is the future of servicing buyers being able to basically price assets as efficiently, as is done on the whole loan side. So again, a great, we're real happy with that, and again, Paul can speak to kind of how we execute on servicing marketplace. That one, I believe MCT also was first in connecting to on the commitment side. And then the last one is the most recent is the whole loan purchase advice seller API. And look, this is more of an operational benefit, not specifically an execution benefit. MCT, as a hedge advisor, one of our primary responsibilities to our lender customers is hedge accounting reporting, or I should say reporting in general, and then at the month end, hedge accounting. And so there are two primary, in the accounting rules, there are two primary components to hedge accounting. There is your derivative asset, and there's your held for sale. So your derivative asset is your IRLC, your interest rate lock commitments that are not obviously locked with a borrower, but not funded. And So those will be valued and at your execution and then adjusted by pull-through. Then you have your funded production, and those are the ones that are funded on the line but are not purchased by the investor aggregator or the agency or the, I should say, securitization takeout. The problem in that held for sale number is historically, invariably, I should say, at the end of the month, the held for sale number was not completely correct because there were purchase advices that were coming in that were not being updated. And so what generally happened is that we would show a held for sale number that was too big because in the loan origination system, the LOS, the purchase advice hadn't been updated correctly or hadn't been updated quickly enough. And so that, of course, made us, have to rerun the numbers and was, a little bit painful for executive management on the lender side because held for sale, just the way that it is included in hedge accounting, it's pure gain on sale, which means that it's everything over par. Obviously, expenses are netted out elsewhere, but it's a large number. So in normal markets, and so when that number is off, it's definitely problematic. And so with the with the whole loan purchase advice API, we're able to get that information directly into our database from Fannie, and so that is a game changer. It immediately updates the updates in our database, and by definition, we'll update our reports. And so again, this is where there have been some aggregators that have have tried to work to do this with some of their customers and third parties like MCT, but at a broad scale, this is the first move that we had seen for purchase advice API. So the efficiency on the on the hedge accounting side is crucial. Paul will talk about some of the potential for write back and the removal of kind of the human manual labor that's currently involved in entering this information into the LOS. But I should say, a third thing, a warehouse line had contacted us about automating the paydown reconciliation. And that's something that's a benefit that we never even, thought of there, because, for the lenders on the line, that's a little bit of an archaic process right now of sending the purchase advice over to the to the warehouse line. So I do think this is again the first step in another example of kind of Fannie innovating here and pushing the rest of the market this direction, and we're definitely excited about that. So Dave, if we can move to the next slide. And this is where I think we'll bring Paul Yarbrough in, who is, I've obviously talk at a high level. Paul can speak to the specifics of kind of the benefits and bring Mike in as well with Fannie side.
Yeah, thanks, Phil, and appreciate everybody being on the call. So we've got a couple of things to talk about with these APIs, and kind of when it comes down to the meat of your process and how these things help. I'll just run through these features, and then and we'll go from there. But and then we'll move into kind of a live demo in MCTlive. So this pulling live note rate pricing, this is huge. I mean, traditionally in any kind of best X or rate sheet service, you kind of had to wait for static rate sheets to be downloaded, somewhat normalized or processed into a pricing engine, and pushed into that pricing engine, so you could pull down the your pricing for the agency execution, for Fannie's execution. Well, now we're able to, we don't even have to wait on that. As soon as Fannie has posted pricing in the morning, you could post a group of loans or price your whole pipeline of loans, pull out your rate sheets and get those into your pricing engine for your LOs as soon as it's posted, and that processing is so easy. So we can move on with our day and focus on other things. So, I would say just anybody in here or on the webinar here that's ever been into PE whole loan, it's a great system. It works very quickly. You can make those commitments quick. But if you have 10, 20, sometimes we have clients that are doing 100 commitments in a day or more. The fact that we have the ability to really deliver multiple commitments with one click, where you're defining those commitments either through a group of loans or through just the high level commitment information. You can click one button to get that done is a big deal. The fact that MCTlive kind of brings all this together in one place is also huge, right? You don't have to go from your hedge platform to your pricing engine to your BestX engine to Fannie site to do all this. With Fannie's integration, it allows us to live in one system where we see our pipeline of ready for sale loans to be committed, and then run the live pricing on those, BestX them against whoever you need to, and make those commitments, and then potentially push that data back into your database of record as well if you need to, so you can start your post-closing process. Going back to that first one, pulling live no rate pricing, I only referenced really, that morning process, but there's also, I think, his intraday process. And this is where I'll bring Mike in, but I think everybody can understand or appreciate volatility, price changes. We've had a bunch over the last few months. And so, Mike, I mean, Fannie is a live price at cash window. And again, just apologies for going backwards in kind of sophistication level. But for everybody on the call, that cash window price, can you speak to that? That's a live price, and perhaps, how often that's updated throughout the day?
Yeah, of course. It's a good question too. And yeah, so the price you see is live, right? So it can move and probably will move throughout the day. I mean, obviously, look, there's key components that go into setting a price for a lender. We don't need to get into all the details, but that's kind of the base. And on top of that, right, we have to look and see where the MBS or TBA market is, because things do move around, especially the last couple of months have been extremely crazy. I can tell you that, our system is kind of set up. We pull in data sources to see where the market is, and immediately digest what's going on in the market. It will adjust accordingly, whether it's up or down. We know that there's big announcements to come out. If the market swings a half a point and then swings right back, are we going to move right away? We try to be on top of it as close as we can. But yeah, I would say it's live. It's moving throughout the day. And, look, if we get into a point where it's getting really volatile, we're not going to let a machine operate, right? We're going to actually have to step in, get our traders in there and manage it, right? So that way we know we're on top of the market, and that way we know that our clients are getting the most accurate price they can.
No, that's perfect, Mike. And I think it stresses the point of why these live integrations are important. Really, literally with the click of the button, you can pull in a new live price to make sure that you've got the most updated information to commit to.
Excellent point. Yeah, because I've seen it before where you go and you see the price, you wait 2 seconds, and it changes, right? So
exactly.
Speed is everything.
And we'll show too. There's kind of two processes, right? You pull pricing and then you commit, and then I'll show in the demo here how we some functionality we put in to compare those two things as well. So, again, just kind of reiterating this, we're streamlining the pricing to improve accuracy and really that speed, right? You don't have to come in and bring spreadsheets together to BestX. I think, we have some folks out there that still rely on a spreadsheet kind of style of best execution. that links to, different static rate sheets and whatnot, and really moving it into MCTlive is kind of, it gets rid of that process and lets you not only best X with accurate and up-to-date information, but also, not every loan is eligible for every investor out there. So you may have some overlays where you can't sell this or that to Fannie or an aggregator, and it needs to go to Fannie, and inevitably you committed to the aggregator because it looked like a better price. Within the MCTlive platform, you can run a preliminary analysis where we can take in specific loan level details. There's obviously the hard overlays, right? Credit score, LTVs and whatnot. But then there's the other things that go on behind the scenes between your processors and underwriters and borrowers, frankly, where a loan can't go here, must go there. And remember, we in MCTlive, we can set that up to where that's already taken care of. So when you see that Fannie Mae execution right there in front of your face saying you should commit there because it's the best execution, it's already taking into account the fact that you can't, you may not be able to sell the loan. So, and then the next thing you'll notice is that, intelligently analyze those loan characteristics. What we're doing in MCTlive is we take a look at, is this a home ready? Is this what's the loan balance? What state is this in? What's the occupancy? The credit score? What are these different characteristics of the loan that help it fit into one of these spec stories, right? More often than not, $84,000 loan is going to go to LLB 85. What if you have an LLB 250? You have a $249,000 loan. Is that better to commit with a New York state pay-up? Is it better to commit if it's an investment property? Is it better to commit as a non-owner? Or maybe it's a home ready, and now with these new home ready specific pay-ups, you're able to execute to those. So within MCTlive, it helps you make that decision, and in most cases is making it for you beforehand. So it's already picking that best price between those spec stories. Okay, let's have that presenter role passed on over to me, and I'll switch it. I'll switch us over to MCTlive here. Let's see, David. I think
Paul, can you care if I just add one thing?
Yes, sir. Please do. While David passes this over.
Just real quick too. I think, and you brought up the home ready that we put out there a few weeks ago. I think just important to note too, when we put these different products or stories out there, I mean, it's at the option of the lender to hit them or not hit them. Usually it makes sense, but for example, to your point, home ready is option. If you have a home ready loan, but if it's less than 85K, depending where the pay-ups are in the market, it may make more sense to commit it as a less than 85. You don't have to hit the products. Once again, we're just putting them out there for you to run the best X and get the best possible price you can. So make sure we're clear.
Talk a little bit about on this next to last slide here with the numbers, just kind of proving up the utilization of this. I mean, we saw a drastic increase just from just from the utilization of the APIs, just from a user standpoint and from our own internal trader standpoint as well. You can see how in 2019 we really first started getting this off the ground here, and then these numbers, it just skyrocketed. I always like the volume is always fun. 104 billion in volume. That's a lot. That's an impressive number. I always like to point to those commitments. 100,000 commitments prior to an API. That if you can imagine, that's 100,000 people doing that data entry, putting those commitments into PE whole loan. So thanks to Mike and his team over there at Fannie, we're able to kind of automate that process. And if it takes you just do the math there. If it takes you 1 minute, or if it takes you 2 minutes, or whatever it is, I think the fastest we've seen from a user doing it hand keying is a minute per commitment. That's 109,000 minutes. That's a lot of minutes. So that these integrations are saving. So. Okay, Phil, I think I'll kick it back to you here.
Yeah, Paul, thank you. No, that was great, Paul. Really appreciate that. And you can see you can see, everyone can see exactly why we had Paul do that that demo, because there's a lot of intricacies there that I definitely would have skipped over for sure, because frankly some of them I didn't know about. So that's that was impressive. So yeah, just to summarize, I think yeah, we're definitely excited with all the innovations that we've been able to kind of utilize with Fannie. Definitely excited for the future innovations that they're that they're working on. And as I said at the outset, we are going to continue to this is the first in a series of presentations. The next one will be a one on what we call the AOT pay-up matrix. So this is going to be for aggregator execution, bid tape AOT execution, and obviously, again, like I said, every basis point counts that much more in 2022 than it did in 2021 or 2020. And so obviously AOTs are, especially with some of the gyrations in the market, and even more so on the Ginny side, AOTs are essential. And so we'll show some of the innovations that we have as far as pushing the pay-up matrix, basically of the bid offer spread pickup that you're gaining, pushing that into the execution. We already do that, but there's some intricacies that we're adding in there, and then also some advantages on an integration that we have with Agile with respect to BAM Marketplace AOTs. So that'll be our next webinar, which we'll have in about a month or so. But really appreciate everybody's time, and Mike, I really appreciate your time and your thoughts. No, like, if you guys have any questions, feel free to reach out to us, or to and we can definitely reach out to Mike and team to answer any of them. I think I forgot at the beginning, just some housekeeping, that we will have this recording out to everyone who registered. So really appreciate everybody's time. And again, we will be back to you with some future webinars here on future execution execution innovations in our execution series here. All right, thank you.